Welcome to the Investing Show, where we discuss ideas to help you make more of your money. I'm Simon Lambert of This Is Money, and I'm joined today by Stephen Paice, Head of European Equities of Baillie Gifford, and also the co-manager of the Baillie Gifford European Growth Trust. Now, Stephen, welcome to the show. This has been a year in which investors have put European shares back on the menu, after initially deciding that they were a bit unsure about the US and the tech giants, but then deciding that actually they quite like them again. And we've seen them soar since Donald Trump's tariff announcements and the low after that. But I'll ask you a bit about how the trust invests and the opportunities that you see in Europe at the moment. But first, what is the picture for European equities right now?
I think the picture for European equities is pretty positive. But I think we're now in this stage where the market just seems to be a little bit, well, on occasion, a little bit less optimistic on the US and a little bit less pessimistic on Europe. But I think when you look at Europe from a macroeconomic perspective, there are some pretty positive signs there in terms of fiscal stimulus coming out of Germany. We're starting to see central banks cut rates, which is going to be more accommodative than before. So I think the landscape for European equities has been improving. Now, a large part of the benefits from the European stock market have come through those traditional value sectors. So not all European investors have benefited from the current environment. And in particular, from kind of 2021 onwards, in Europe, certainly, we have seen a big rally in value investing. So those companies involved in banking, energy, utilities, insurance, those are kind of classic domestic value areas which have benefited. And any kind of growth investors that have had underweights towards those sectors have found it a bit tougher. But I think where we are today, a lot of those really high quality growth companies in Europe, which reside more in those technology, healthcare, and industrial sectors, are now trading at extremely low relative valuations. And I think when we look forward for the next few years, I think that's where the opportunity in Europe is going to be.
And that focus on value rather than growth has obviously been tough for yourself. The clue's in the name, Baillie Gifford European Growth Trust. But presumably it presents you, as you said, with an opportunity, because there comes a point where if people aren't so interested in growth stocks, then they start to represent a value opportunity as well.
Of course, I mean, value is a component of growth investing and vice versa. But I think where we are today, over the last couple of years, the US has seen a very different dynamic where a lot of the growth companies in the US that are exposed to AI and big tech have benefited and have seen their share prices rise, but we've not seen that yet happen in Europe. But exactly what you've pointed out, this is the opportunity. The Baillie Gifford European Growth Trust does exactly what it says in the tin. We're trying to find and invest in Europe's best growth companies. So naturally, that will mean that we typically take less exposure, less bets towards those value sectors which aren't growing as fast. But today, I think those valuation discrepancies, when we look at the valuation multiples, but also the fundamentals of these very high quality growth companies, there's something not quite right there. And that's the inefficiency that we want to try and exploit over the next couple of years.
And before we talk about some of those companies themselves, how would you describe your investing style and also, what the trust tries to do for its investors? Do you worry so much about the big picture stuff we talked about at the beginning, or is it really more about those individual companies?
We do think about the big picture stuff because ultimately, over longer periods of time, some of these structural forces at work are the most important ones to get right, whether that's what's happening in AI, whether that's something to do with consumer behaviors, whether that's the way we shop or buy things. A lot of these kind of structural thematics are super important over the timescales that we invest in. It's almost impossible to try and predict short-term behavioral effects on stock markets and the valuation multiples which can fly around over the short term. I mean, when you kind of think longer term, over 5 or 10 years, what really matters is getting exposure to the right structural growth, but also aligning yourself with companies that have very strong corporate cultures that are going to be able to exploit those opportunities in front of them.
And to talk about some of those companies, you invest in both private and stock market listed companies, don't you? And I must admit, when I looked at the top 10, there was a name at the top that I didn't recognize, a company called Bending Spoons. What does that company do and why do you hold it?
So you're absolutely right. We invest both in public equities so that you can buy the stock markets, but also private companies that have chosen to remain private. And that's a phenomenon that we're seeing in Europe play out as it did in the US. A lot of companies don't feel the need to come to the public markets because they don't require as much capital. And there's lots of kind of negatives associated with coming to the stock market in terms of lots of admin and having to deal with shareholders and everything else. So we're finding that some of the best companies in Europe are actually still private. And until maybe 3 years ago, I'd never heard of Bending Spoons either. But I think it represents a fantastic example of what Europe can do when innovation can scale up into something quite profound. And I don't think there's anything like Bending Spoons in the European market or in the listed market. And I don't think there's anything like it in the US market either. But what it does, and it's a reference, the name of the company is a reference to one of the scenes in The Matrix where the kid bends the spoon. But the business model is really about buying consumer applications, consumer apps, and they will typically buy these apps from other companies that just can't make money with them. And a lot of these will be based in the US. And what they do is they take these consumer apps. Some examples would be Evernote, which is a productivity tool, Vimeo, which is a video platform. They've recently just bought AOL, which was obviously quite a high-profile tech company back in its day. But that's more of an email user base that they're looking for. But they take these consumer apps, which are not making a huge amount of money, and then they sort out the cost base by transplanting all the operations to Italy. This is a Milanese company, so they use their extremely skilled, high-quality engineering talent in Milan to reduce the cost base, but they also invest in these apps to increase the monetization. And it's kind of a flywheel. They start off with some smaller businesses that they acquire for a very low price. They transform those companies and they use the cash flow to then buy another company. And this is a kind of a playbook that they have used extremely successfully over the last decade. The CEO, an Italian entrepreneur called Luca Ferrari, started this business just over 10 years ago with 10,000 euros. And with the recent funding it raised, and it's now valued around $11 billion. So this is a big position in our trust. It's around 9% just now. But most importantly, we still think there is a huge opportunity for Bending Spoons to continue acquiring these consumer apps, making more money with them. And that valuation today with 11 billion, I think could be multiple times bigger in the next few years. And I think that's what's super exciting and quite unique about the opportunity. You don't get to invest in these types of companies anywhere else, but it's our largest holding.
And is their aim to then continue with that company and continue making money with the company that they've bought, or do they aim to sell it off or list it on the stock market itself? Is it different to a venture capital approach?
I mean, they describe themselves as kind of 25% private equity and 75% tech. And they will buy these companies, but they will buy them to make them better and to keep them. They are not going to do the typical VC model where you buy something, you sack a few people, and then you flip it on for a higher price. They are investing in these apps, and they have a toolbox of AI that they can apply to all of these apps to improve monetization, engagement levels, and everything else. So they are extremely good, and they are probably one of the most coveted IT jobs in Europe. I think last year they had something like 600 or 700,000 applications to work there. And that was for a couple of hundred jobs. So this is a company that we will hear a lot more about in the future, particularly if it chooses to list on the public markets.
And another company at the other end of the tech scale, I guess, but one that perhaps gets a little bit overlooked with all the fuss about chip makers and the world's largest company like Nvidia, is ASML. That's another big holding for you. Tell us, why do you hold ASML, and what's the attraction there, and why do you think it can continue growing?
ASML is arguably the most important technology company in Europe. And that is because it has a monopoly position in certain lithography tools. And these lithography tools are used to make microchips. They are used to effectively print semiconductors. And these semiconductors are then obviously manufactured by Intel, TSMC, NVIDIA. So without ASML's lithography tools, we would not be able to produce the semiconductors that are required for this AI revolution that we're facing just now. In fact, its chips are used for GPUs, for large language models, for autonomous driving. There's a whole range of applications that without ASML's technology, we would just not be able to have. And that's why it's such an important company for this progress towards cheaper and faster and more efficient semiconductors. So without it, it's really structurally and strategically important for not just Europe but the whole world.
And how has it performed in comparison to an Nvidia, for example?
I mean, Nvidia is something of a unique case in terms of the appreciation in the share price over the last few years. ASML more recently has done a little bit better, as some of the narrative around AI and the spend, the infrastructure spend, which is going to happen hopefully over the next few years, starts to benefit some of those picks and shovels types of businesses. But as I said, ASML has a monopoly, and it has a lock-in with its customers. It has very good visibility in terms of the order trends that are coming up. So again, this is a company that might not see the remarkable boom in its share price that something like an NVIDIA has had, but we will hopefully be able to see something like the ASML compound and generate a lot of value for years to come. So hopefully less volatile as well.
And when you're looking at ASML or any other, tech company or anything to do with AI at the moment, how do you look at that and think in terms of these concerns over an AI bubble and everything? What are you thinking as an investor? Investing your shareholders' money. How are you approaching this?
I mean, it's a good question. I think that question is more on the lips of those that are investing in the US. When you look at the S&P 500, for instance, the concentration in that stock market in terms of the performance, but also in terms of market cap and how important those big tech companies are as a component of that market, I think the risks there are much greater. And this is why when you read the newspapers, the financial press and everything else, you will see a lot of articles about, are we in an AI bubble? And we could have another show about an interview about why we maybe are in an AI bubble and why we are not. But for European investors, I think we're slightly de-risked. And I think that's part of the traction as well of Europe more generally. Investors are trying to diversify some of the risk away from what is a very concentrated bet on AI within the US stock market and take advantage of perhaps a broader opportunity set of growth investments in Europe. But when it comes to kind of the risks of maybe the AI spend plans and forecasts not coming true, that is something that we have to incorporate into our valuation work for something like ASML. But we don't have in Europe as many of those large language model type businesses. We don't have it in NVIDIA. We don't have some of the hyperscaler companies that are building out cloud infrastructure. So I think the risks are far less. But we do also have to think about how AI is going to disrupt a lot of companies that reside in Europe as well. And that's another fascinating topic as well.
And I guess, on your point there about the sort of investors thinking about, maybe moving a bit of money away from the US. The US is now such a large position in the global stock market, and the US tech giants are such a large position in the US stock market, that it doesn't mean everybody's going to have to suddenly go, all right, completely ditch the US. It's only a relatively small amount of that money moving its focus to Europe brings a considerable tailwind, presumably, for the kind of companies you're investing in.
Exactly. And we would never try and tell anyone how to allocate their assets or their investments, but it seems clear to me that over the last, I've been at Baillie Gifford for 20 years. I've been investing in the European market for 15 of those 20. And for most of that time, we have seen outflows from the European equity market. We've also seen that in the UK as well. And I think that investors need to seriously consider just that allocation and to take advantage of the fact that a lot of money has been taken away, it's been sucked away into this gravitational pool that you get in the US tech companies. So yes, if we see a slightly more rebalanced or rebalancing with money coming back into Europe, and to take advantage of these attractive valuations, I think that's going to benefit some of those companies there.
And another company that I understand you've recently taken a position in is one that probably wouldn't fit into most people's ideas of a growth company. It's Roche, a healthcare company. Can you tell us a bit about why you invested in Roche and also, any opportunities you see in that sector as well?
Sure. Roche is one of the largest pharmaceutical companies in the world. And as a sector, I would say that the pharmaceutical sector, because of perhaps an industry-wide slowdown in innovation rates, perhaps, or at least the cost of innovation, and some of the issues with tariffs and pricing in the US, has meant that the valuation multiples across pharmaceutical companies are at kind of record lows. Now, that's not the main reason we want to own it. We want to buy high quality growth companies and pay a very good price for them. But one of the attractions of Roche at the moment is that it went through 2 or 3 years where it suffered kind of an R&D productivity problem. It had a number of high profile phase 3 trials which failed, that didn't produce the drugs that they'd spent a lot of money on. And we had a new management team come in. We've had a new head of the pharmaceutical division come in, and they've basically reset the R&D process. And they are effectively now producing more drugs that have a better chance of approval with better payoffs. And I think we'll see over the next hopefully 12 months or so, the data that backs up what they've been doing in terms of the success rates improving and in terms of peak sales and everything else. So I think that's the opportunity here. It's investing in underappreciated growth. And when you look at kind of the forecasts that are out there in the market for the growth rates at Roche, they're extremely low. And that's how you make money in stock markets. You have to have a differentiated view and you have to have a varying perception. If Roche is going to grow faster than what the market is pricing in, we should make money. And I think that's the kind of the key attraction here. It's a high quality company. It's got one of the leading franchises in cancer, in immunology. It's moving into obesity as well. It has a diagnostics business. So there are lots of attractions here, and we're not being asked to pay a very high price for those shares either.
Stephen, that's all we've got time for. Thank you very much for joining us on the show.
It's been a pleasure.
And thank you very much for watching. Join us next time on The Investing Show. Goodbye.